From our 22 News Broadcast Center, this is 22 News in Focus.
Good Sunday afternoon and welcome to a special live broadcast of 22 News in Focus. I'm Barry Krieger. President Trump signed the new tax reform law on December 22nd. It is formally entitled the Tax Cuts and Jobs Act of 2017. Many people are confused about what is in this new law and how it will impact individuals, couples, and businesses when it comes to paying taxes, your taxes. Today on 22 News in Focus, we are doing our part to clear up some of the confusion by taking a closer look at the tax reform law and what it means for you. We've also invited our viewers to submit questions through email. Joining me today, we have Paul Mancinoni, a CPA and owner of Paul L. Mancinoni Company in Springfield. And a little later on, we're going to bring in Mark Teed, Senior Vice President of Investments for Raymond James and Associates. Let's start off with the new law, which is considered the first significant reform of the tax code since 1986. Paul, thanks for coming in today.
Thanks for having me, Barry, always.
Great way to spend your Sunday afternoon.
Live.
When President Trump first talked about the tax reform, he was saying this was going to be a simplification of the tax codes. Yeah. Did they achieve that?
No. This is not a simplification by any stretch. There are certain people that will no longer have to itemize their deductions. But no, it's in fact, it arguably got more complex because especially in the business side, Barry, you're going to see more attempts at gaming the system, more opportunities. A new series of loopholes are going to emerge over the next few years.
The same way people that would itemize deductions and find places to pad those deductions, you're telling me there's a whole different class of that going on
Those
now.
Discussions are already emerging, absolutely, Barry. But simplification, I would not use those words. That one card, you'd be able to file on one card, that is not happening.
You said on a postcard?
Yeah, no.
It'd be a very big postcard.
It would be a very big postcard, absolutely.
So as a certified public accountant,
yep,
your job is going to get more labor intensive, I would guess.
This will be a very busy year, and it'll be a very busy year, Barry, particularly for my business and corporate clients, because they may be revisiting if they are the correct form of entity, S corp versus corporations, et cetera.
Right.
But this will be a seminal year in the tax profession.
Well, while you're talking about corporations, let me ask you a question that we all kind of already know the answer to is who are the big winners from the Tax Reform Act?
Corporate America. I mean, a 35% tax rate, Barry, down to 21 is a 14% drop. That is basically, and Mark can attest to this better because we've seen the results in the stock market. You're adding 14% to a corporation's bottom line. So when you look at a publicly traded company that may be getting a 7 or 8% return, add 14% to that. It's monstrous, and they're the big winners here.
And in some cases, we were hearing about this in the last week or so, there are dozens of big corporations that are actually issuing bonuses to all their employees.
Absolutely.
There's some kind of euphoria going on among the big corporations.
It's a big tax savings, Barry. I think dividends are going to be paid out to shareholders. There's going to be an increase in dividends. I think there's going to be an increase in investment. I think there's going to be hiring. I think there's going to be more of the bonuses that you're referring to. Because again, a 14% savings to a big corporation, we're in the billions. That's big money.
Yeah.
It's big money. This is a big savings.
President Trump said he was surprised by that. That wasn't something that he anticipated would happen, that corporations would actually reward their employees with their savings that they were going to make, that they were anticipating for the coming year.
I didn't anticipate that either. I didn't expect to see that. I thought maybe we would see a spur in hiring or maybe some immediate increases in dividend payments. But hey, whatever helps employees of the companies that are getting these bonuses, great.
I know it hasn't filtered down to us just yet. But
I haven't given myself a bonus in any way, shape, or form, so I'm glad you pointed that out.
All right, so now we know who the big winners are. Who comes out being one of the big losers in tax reform?
Well, you know, there's the loss, or the minimization, rather, Barry, of the state and local tax deduction. There are some, I've ran the calculation for some heavy taxpayers, and this hurts them. And it hurts states like Massachusetts, Connecticut, the states that have income taxes.
Should we explain what that is? I mean,
yes.
They talk about local income taxes. We don't have that in Massachusetts, but we do pay state income taxes.
Yes, thank you. It's called, the acronym is SALT, S-A-L-T. State and local tax, state income tax and local property tax. Those two combined cannot exceed $10,000. So if somebody's paying, and we have some suburbs of the greater Springfield area, Barry, where some people are paying $10,000 just for their real estate taxes.
Right.
And they might be paying $10,000 or $15,000 in state income taxes. That's $25,000. That's limited to 10. And that we only got the 10 because of Senator Sue Collins of Alaska. She mandated that, or they weren't going to get her vote.
I want to talk about that just a little bit more so that I understand it. They are combining what you pay in, say, property taxes in Massachusetts. That's what's relevant is property taxes. And normally what you pay for your state income taxes, that comes right off the bottom line of your total incomes, your gross income.
Correct. Yes.
So now that's going to be $10,000.
Limited to 10. That's a big hit for some
someone
people.
like you were talking about a moment ago who's paying $25,000 or has $25,000 in property and state taxes, their annual income is going to go up by $15,000 that'll be taxed.
That is correct. That is absolutely correct. By doubling the standard deduction from $12,000 to $24,000, Barry, and limiting the state and local tax deduction, we may get fewer and fewer people who actually need Schedule A to itemize their deductions because the $24,000 is so attractive.
Yeah, that was, I think, a goal of President Trump's was to eliminate itemized deductions.
Well, I think he did it for a lot of people. Yeah.
That's an interesting thing to do. I mean, there's all other kinds of deductions that people take into account. Big medical deductions, if you have big medical bills and dental bills.
Yeah.
And even that it's hard to achieve that threshold if you're trying to do that.
But Barry, one of my concerns, one of my big concerns here, with respect to the doubling of the standard deduction, is if you are paying $5,000 in state and local taxes, and you're paying $10,000 in home mortgage interest, that's 15. The government's giving you 24. My fear is it's going to discourage people from making charitable contributions, which as a whole is one of the largest industries in the United States. That scares me.
There's a lot of implications about the mortgage interest rates and such like that, and the SALT, of course. That is one of the big deductions that most homeowners take, is your mortgage interest.
Absolutely.
And there are changes there as well.
There are changes there as well. It was up to $1 million of mortgage, and now that's been dropped to $750,000.
In other words, if you have a bank loan for $1 million?
Yes.
Okay.
So if you had a bank loan for $1.2 million, you
against
can only,
your house.
Exactly. You can only deduct the interest as it applies to $1 million of the $1.2 million. That $1 million got dropped to $750,000. So thus, those taxpayers in that area have to do another calculation to limit their interest. Yeah.
So what do people, will that make your job easier or no?
I don't see my job getting easier with tax reform, Barry. I would like that at my age, but I don't see that coming. But I am concerned about home builders that build upper echelon homes, because what's the encouragement if you can't deduct the interest? And so I do have concerns for some business people on how this will affect them in some industries.
So, I mean, but this is a learning process. I mean, this is the first year, actually just the first few days of 2018.
Yes.
This is a very young, very early on in the process. You're learning and everybody's learning about
this.
Well,
it's a good thing to note that the technical corrections bill by Congress hasn't been issued yet. And then after that, the IRS issues its regulations that interpret what just happened. So we're looking at raw law that hasn't even been interpreted yet. So that makes it somewhat confusing.
We are going to continue this discussion. How will your personal income taxes be affected? And we'll be examining the new tax brackets and the increase in the standard deduction when we return. You're watching 22 News in Focus. And welcome back to 22 News in Focus. Today we're talking about the new tax reform law. Let's get down to how the new law will affect the average person's income tax return, your tax return. Again, we should note that none of this affects your 2017 taxes last year. The new law will only be applied to filing for your 2018 taxes, which happens in 2019. Now, the tax brackets have changed. We still have 7 brackets. Trump wanted to reduce that to 4, but that's not what we got. We have graphics that show the new tax rates. Tell me a little bit about what you think about the new tax rates.
Well,
they're a little lower, right?
A little lower. They kind of just shifted some of the income around. I think everybody who's making pretty much the same as what they made last year will find themselves in a 2 to 3 point drop, which is a good place to be.
Okay, there's the individual tax rates right there.
Here we go. Yep.
So the thing about this, okay, not exactly easy to understand.
Yeah.
But
There's 7 brackets. So.
The 7 brackets,
Yeah.
right. I have another graphic there, Amy, if you can find that. It says 2018 individual. But all the brackets changed. They came down a couple of percent.
Yeah.
The only one that's the same is the 35%. But while the brackets, the tax rates are coming down,
Yep.
to get into those tax brackets, you have to earn more money.
That is correct, of course. And to get to the higher brackets, the more you earn. And the top rate will be at 37%. One of the things that I did notice in my research when the bill first came out and I was comparing the tax graphs from 2017 to 18, Barry, was there's a strange sweet spot between 233 and 315,000, where that's a 9-point drop from last year. That's hard to get into that income area.
Yes.
But it's sweet when you're there because that's a.
So certain high income earners are going to
But just yeah.
big benefit.
Let's not lose sight of the state and local tax deduction, Barry. I got to tell you, it's a bear. But everybody's getting a 2 to 3 point drop in general. But there are a couple that are getting more than that.
You know, there are always people who are always trying to find a way around things and loopholes,
Yes.
tax loopholes. Now, this state and local tax new limitation, I imagine that's going to spur a lot of people searching for loopholes, maybe in unexpected places.
Absolutely. That always is the case, gaming the system. You know, that's as old as the tax code.
But usually it's guys like you. Now I'm hearing it's governments trying to do it.
Well, yeah. Going back to the state and local tax, Barry, California, there's 2 legislators. I was astonished to hear this, but it's really novel. Are actually, because California has a state income tax, and they're going to be penalized. Their
Right.
taxpayers will be penalized by not getting the full state and local tax deduction. Silicon Valley, San Francisco, LA, there's a lot of big income there. And they are thinking about creating a state-sponsored charitable contribution, where if you make a contribution to that state-sponsored charity, that basically goes to the budget in certain areas, probably schools, you will get a tax credit. And so I thought that was fascinating to try to move from the state and local tax deduction that is limited now over to the charitable contribution side to game the system. And Governor Cuomo in New York, which
So
is
in other words, turn the state into a charity. I mean,
well, 2 legislators in California are
Essentially, that's
actually
what they're
kicking
trying to
that
do?
around, and I guarantee that's going to get. I don't know if it's going to pass, but it's going to get a serious looking at.
if it passes, it's probably going to go to the
Fantastic.
Supreme Court of the United States.
Absolutely. Speaking of the Supreme Court, Governor Cuomo in New York State has indicated that he believes what they're doing to the state and local tax deduction, which hurts New York more than any other state in the country, is a violation of the Equal Protection Clause of the Constitution. So I think we may see a legal challenge on that aspect of the bill as well.
Governor Cuomo's calling the Tax Act unconstitutional.
Absolutely. That aspect of it, the state and local tax aspect of it, yes.
What about Massachusetts? Are we going to be hurt here?
Well, you know, we have a Republican governor, so I haven't heard a lot of outcry about that. But from taxpayers in Connecticut and Massachusetts, 2 sister states when it comes to taxation, there's a lot of outcry from taxpayers realizing the gravity of again that limitation on the state and local tax deduction.
Our friends in Longmeadow, our friends in Southwick, they're going to be hurt.
Absolutely.
Those are people that have the $10,000 property tax
Yes.
bills, and then never mind what you earn from the state.
Absolutely.
So
Their mortgages could be limited because there's some nice homes out there, and so we'll see what happens with this.
it's basically some people are getting kind of a salary cut.
Yeah.
You know, you want to get a raise. Big corporation in America got a big raise, but a lot of people are not. We had that graphic that I was alluding to before. If you can call that one back up, Amy. You had it up a few seconds ago. That shows pretty clearly what the new tax rates and the
Yes.
new tax brackets are. There we go. Where's that sweet spot you're talking about?
That is
Is it the 35?
not there. That's not it.
That's the
No,
individuals.
well, first of all, to see it, it has to be compared with prior years.
I see.
Yeah, but
so
that's,
each one
I
of those is
believe,
probably
single.
about 2% less than
That's an individual.
last year.
What I was referring to is for married filing jointly.
We've got that one
But yeah,
too.
there you go. That's the tax rate for individuals, and everybody's going to see a 2 to 3% tax rate. There you go. The 24. See the 24% area?
There it is.
The 165 to 315. Well, from 233,000 to 315 last year, you'd be in the 33% tax bracket. Look where you are now at 24. That is a very interesting sweet spot in the entire analysis there.
This is for couples that are earning between 165,000 and 315,000.
I realize that that's a slim amount of the population, but I just thought in looking at the Tax Reform Act, I thought that was an interesting.
Well, there's
twist.
incentive to earn more, isn't there?
There always is. Even if the tax rates were high, there always is. This is America, Barry. Yeah. So really an interesting time. This is the first time in January where I'm actually not focused on the current tax season, but I'm thinking about the tax season that's still a year away because of these changes. Being here with you today, for example.
I was thinking the very same thing.
Yeah.
That right now, people usually, towards the end of the year, you start making tax plans.
Yeah.
And now you're getting your paperwork together so that you can sit down with a guy like yourself and figure out what you're going to do, if you're going to have to pay taxes or if you're going to get a tax refund sometime in the next coming months. But right now, everybody's studying 2019. What you have to do this year.
Absolutely.
To be ready.
Well, in all fairness, Barry, as people are looking at the changes in the tax law, they may be thinking about, well, Paul, maybe I'm withholding too much federal tax. Everybody says my taxes are going down. Maybe I'm withholding too much, and why don't we run a projection to see if I can change my withholding? We're doing some of those in the coming weeks.
And this is the kind of thing that people should be thinking about doing now,
I
too.
think so. I
Sitting
think
down
so.
with their, but this is a busy time for you guys. Do you have time to thinking about next year while you're doing this year's taxes?
We're live on television, Barry. Yes, I do. Truth might be another story, but we're live, and I'm going to.
How about people that file with a 1040A tax return? What changes are in store for those people?
Well, a couple of things, Barry, because I've been thinking about that a lot. We are dealing with a form for 2018 that hasn't been created yet. So I don't think it's going to be the postcard. We talked about that.
Yeah.
But there will be a simple form because many people are no longer going to require Schedule A for itemized deductions. My office obviously doesn't do a lot of 1040As. That's
Right.
a different
Well, it's the
segment.
thing most people do at home.
Yeah, it's a different segment of the tax-paying public, which is great. And I encourage people to do their own taxes, and I think we're going to see more of that as time goes by. But yeah, I believe there will continue to be a simple form, and I think we're going to see more of those being filed.
If there are more people filing with the 1040A, in that instance, Trump's prediction that he was going to simplify taxes actually comes true.
I think so. By considering what he did to the standard deduction, no question it's going to make that aspect of filing simpler. And I think we will see particularly younger people, Barry, venturing off to their office supply store to get TurboTax to try doing their own, and I encourage that.
All right.
Yeah.
What about exemptions, the personal exemption?
Gone.
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 What does that mean?
Family of four had a deduction of $16,200. Zero. It's gone. Part of the Tax Act was to increase the child credit to $2,000 in exchange for removing these personal exemptions. Thank you for bringing it up, Barry, because it brings up another segment of the population that gets hurt. Once your child is over the age of 17, it's not a $2,000 child credit anymore. It's only $500. So while your child goes off to college and you're paying that incredulous bill, you even lose the child credit on the other end, and you don't get the personal exemption. That's one of the parts that trouble me about this Tax Act, in the sense that they didn't do anything to help people that are sending their kids off to college. I have a daughter who's 18, so it's on my mind.
Oh, yeah.
Yeah.
Okay.
It's on my mind a lot as we speak, Barry.
Well, we got a lot more to discuss, so step right there. We will continue our conversation on personal income tax changes. We'll also have some answers to some of the questions submitted by viewers when we return. You're watching 22 News in Focus. And welcome back. You're watching 22 News in Focus. We are live today. We're talking about the new tax reform bill and answering questions sent in by viewers. Again, this is a live program. We have with us today certified public accountant Paul Mancinoni. We have a question sent in by Clyde. From Springfield. Clyde's question reads, and it's multi-part, I retired in February. What does the new tax plan do to those of us who are collecting Social Security? Let's start with that right now.
Well, thank you, Clyde, for the question. I see no changes in Social Security. In fact, I only see things that are beneficial for people receiving Social Security, and that is the doubling of the standard deduction. So if somebody, for example, Barry, is getting $24,000 in Social Security.
From Uncle Sam.
Yes, married filing joint, you're getting a $24,000 standard deduction. So the elderly people that I know who are receiving Social Security tend not to itemize their deductions,
right.
So their home's paid off, et cetera, or they're renting or what have you, living with their children or whatever the case may be. And so we're seeing fewer and fewer people itemizing. Now that doubled the standard deduction to $24,000, I think a lot of Social Security is more than before is being sheltered. So I think it's all good news for Clyde.
So that doubling of the standard deduction is really helpful to some of our elderly taxpayers.
Absolutely. There's the people who rent, Barry, to say nothing of people who rent who never owned a home. This really equaled the playing field, where if you didn't rent, you get a real boost to $24,000 because the renters never came close to that.
That was also an incentive to home ownership too. That's one of these side benefits that you think about, and you got to wonder what the implication will be going forward.
It's one of the things that bother me about that. Are we still encouraging home ownership? I alluded earlier, Barry, are we still encouraging charitable contributions like we did before? That's something that really concerns me. Alzheimer's research, cancer research, hospitals and universities. So I've been thinking about that. Clyde's second part.
Yeah, it was, will I have to, well, before you get there, will I have to pay taxes on all Social Security benefits?
No, same as before. That didn't change.
It only goes to 85%, right? You get 15% that's exempt from tax.
Yes, and again, keep in mind that wonderful $24,000 standard deduction.
And then he wanted to know about medical deductions. Have they been eliminated?
It got better than ever. I don't know Clyde's age, but prior law, if you were over 65, you had to get over 7.5% of your AGI, adjusted gross income, before you could itemize deductions. There was a floor. And for everybody under 65, it was 10%. They went back to the law that existed 3-4 years ago. 7.5% is the floor. So let me use a dollar amount to make it easy for 22 viewers. If somebody makes $100,000,
okay,
you have to get over $7,500 of medical expenses before you can take that.
And that includes dental expenses as well.
Yes, it does. Yes, it does.
All right. So, and then after that, after your $7,500, you can deduct everything above that from your gross income.
I hate to say it, but when I see medical, something significant happen to that individual during the year, it's a deduction not worth having. But when I see it, something significant went down. But let's hope nobody has to have that.
All right. I wanted to address mortgage interest again. Homeowners can still deduct their mortgage interest,
yes,
but there are caps on it now that they weren't there before, or they've changed it.
They dropped the cap from $1 million down to $750,000. So if you have $1 million mortgage, I realize that that's an absurd sum, but they're out there, especially in the eastern part of the state where I have some clients. You have to take 3/4, $750,000. 3/4 of your interest becomes deductible. Only the $750,000. So you do a pro rata math. That's what your accountant would do to arrive at what's deductible. That's where we are.
Once you're in those areas, you would think somebody has the income where they could pay their taxes.
I don't. They complain, but
I'm not trying to encourage class warfare here.
But on 22 News, we don't do that.
What about alimony and child support?
Alimony, child support, no change. It was never taxable and it was never deductible. Alimony fascinates me. After December 31st of 2018, any divorces finalized after that date, alimony is no longer deductible to the person paying it, and it's no longer going to be income to the person who receives it. That is not for existing divorces and alimony plans that are already in place. Those are going to stick with the old law. It's for new divorces.
New divorces starting this year.
No, January 1st of 2019.
19.
Yeah, so
they staggered this. They put it off a year.
It makes me wonder who in Congress was thinking, I really need to put this off a year because things aren't going good at home or something. I don't know. Something went down there.
I'm trying to comprehend what you said. I might ask you to clarify that a little bit.
Yeah.
Are you saying it's going to become sort of revenue neutral?
Yeah.
So the wife or husband who's receiving the alimony, it's not income.
That is correct. Nor is it deductible.
Nor is it
to the
deductible.
payer.
So it's just something out there.
It's going to be like child support, revenue neutral. Yep. Yep.
All right. What about the alternative minimum tax?
You know, the alternative minimum tax in this whole Tax Reform Act, Barry, is of great interest to me. The alternative minimum tax is a separate tax from the normal tax code. And what it does, Barry, is it makes sure people don't have too many itemized deductions. They don't want people getting away with too many itemized deductions. So the biggest add back in the alternative minimum tax was your state income and local property tax.
Right.
So what fascinates me is they say that they didn't say they didn't repeal it, but they minimized the alternative minimum tax, but they didn't. By taking away much of the state income and local tax, he brought a little bit of the alternative minimum tax mainstream. In other words, we don't get the deduction like we used to. And that kind of puts us in an AMT framework. I just thought that that was fascinating. So that's why I say I question, for stronger income earners, I question what kind of savings they're really going to get.
So in some ways, what Trump has done and what Congress has done with this tax reform is to sort of level the playing field. I
think so. They certainly did with renters versus people who own homes with the standard deduction. They certainly did a lot of that. But I don't know how the playing field was leveled with respect to corporate America versus individuals. We did not get the cut that they got.
No, you're quite right there. But, and when I was saying that, I was responding to what you were talking about income earners,
absolutely,
not corporate America.
Oh, of course. Yeah, they tried to level the playing field for sure.
Yeah, you would address that a little bit earlier about renters benefiting. I mean, renters were at a disadvantage because they couldn't itemize, so they didn't have that big interest and property tax that they could deduct. So how are they benefiting now?
Well, they couldn't itemize before because they had no real estate tax and they had no home mortgage interest, obviously. But so therefore they couldn't itemize. But by this tax act doubling the standard deduction to $24,000, that gives them a deduction that is equal to paying real estate tax, paying a home mortgage. So they get a bigger deduction than they otherwise would have gotten in the prior law.
Yeah, you keep coming back to this raising the standard deduction.
Yeah.
Apparently you think that's very, very significant in this whole tax act.
Yes, I do. I think that is the biggest area of simplification. I think it's the greatest leveling of the playing field. It gives me the greatest concerns with respect to charitable contributions that I alluded to earlier. And it also plays into that state and local tax deduction minimization that we saw, because you're going to have people who were able to itemize before because of that limitation maybe being closer to the 24,000 where they say it's not worth it.
So people who rent will benefit.
Absolutely.
And this goes back to that thing you were talking about a moment ago where you're saying this may discourage or maybe not give us as much incentive to home ownership.
Absolutely. I think there's some truth to that. And I'm also concerned about home builders as a result.
We're just going to have to keep watching this play out.
There's nothing else we can do. Thank you, Barry.
All right. Well, will there be any changes to your investments and retirement accounts under the new tax plan? We will bring in financial advisor Mark Teed to participate in our discussion after this break. You're watching 22 News in Focus. Welcome back to 22 News in Focus. Today we're talking about your money and the new tax reform plan signed into law by the president in December. Now, we brought in Raymond James financial advisor Mark Teed to talk about your investments in 2018. That's the year we're in now. Mark, thank you for joining us.
Of course, Barry.
What about the stock market? It's kind of out of control, it seems like. It seems like there's a new record for the Dow Jones Industrial Average almost every day. A month and a half ago, it hit 24,000. Last week, it hit 25,000. There's new records all the time. What's driving this?
Well, I want to explain the stock market last year with using two popular songs that are out there right now. The first one is there was so much bad news out there that just got shrugged off. So I want to use Taylor Swift's song, Shake It Off.
Okay.
Nobody, any bad news was just immediately discounted. North Korea, Iran, anything. And then the other song I'd like to describe last year's market was Perfect by Ed Sheeran. Everything just worked out perfectly. Interest rates stayed low, growth was there, the tax reform got done, the market earnings went up, everything worked perfectly last year.
All right. Well, some people, there are always going to be naysayers. There are always going to be the people that say, this is a little too good to be true. I have something here from Morgan Stanley that came out this week or this weekend. They're saying we have reached the euphoria stage. They have these stages of bull markets. And they say that's 8.5 years in, we're in euphoria. That's the final leg of the bull market. What do you think about that?
Well, there's theory about that. There's the first leg, the second leg, and now the third leg would be the euphoric leg. But that's the most explosive one. So that could take us from 24,000 maybe to 30,000 very quickly. That's the third leg that everybody jumps in. Everybody feels like they missed the market last year, the last 5 years, and everybody jumps in at the same time and just takes the market way higher.
So you're still seeing some growth in this market?
It feels good, but for the first time, I don't want to be Debbie Downer here, but for the first time, I'm starting to think that...
You're always the guy that says stay the course.
Well, I have stayed the course, and now we're doing well. But, for the first time, we're starting to see some clues that maybe this is getting a little bit tired and not to rush into this market.
It is kind of frightening. While we're talking about taxes, there's long-term and short-term capital gains. People that, aside from your tax-sheltered retirement accounts, people who trade on stocks, has anything changed with regard to those? Paul, do you know?
No changes in the treatment of short and long-term capital gain. There's been no changes there. Yep.
And when people actually make money in the stock market, that is not added to your earnings. It put you in a different tax rate, or does that? How does that work?
Well, no, it's taxed differently at its own rate. Yeah, 20. But it's not added to your 37% or anything like that. And you can use your losses to offset your gains. So Mark and I are always in communication in the last month of the year to talk about clients of mine who might have had gains, but is there anything that had a loss? And when you invest with Mark, there's fewer and fewer items with losses, thank God. But we try to find that opportunity to minimize taxes. There's some good planning in that area.
Yep. Now, I know from the past, and unfortunately I know from experience, that you can write off $3,000 in losses in a tax year if there are no gains to write them off against.
Right.
Has that changed at all?
No changes to the...
So they didn't do anything to the stock market?
That seems to work well. Yeah.
Or capital gains for real estate if you buy or sell a house?
That gets a little different, but if you're the casual investor, that would be capital gain. But if you're in the business of selling homes, that's treated completely different. It's like your inventory.
All right.
Yeah.
Has anything changed with regard, or is there any new incentive for adding to your retirement accounts, your 401ks, your IRAs, your Roth accounts? What do we see there?
Barry, that's what I was hoping for in this tax reform, was to raise the limits dramatically, because people are not saving. We see it every day in our practice. There's just not enough people putting enough money away for retirement. So we were hoping that they would increase the limits, make it more of incentive to save through the tax code, but they really did not. They made no changes.
None of that happened.
None of that happened.
None of that happened. So I know you can put money away, tax sheltered or pre-tax money in certain IRAs, but they have the after-tax IRAs and 401ks that are Roth. So does that give you more incentive to fund a Roth IRA, something that you would fund with after-tax dollars?
That's a good question for Paul, but from a personal perspective, I like the idea of the Roth. I like people, when they're young, funding a Roth, because for the rest of your natural life, there's no taxes due on that money. You don't have to take required minimum distributions. The money compounds tax-free. But for people that need the immediate deduction, I'll defer to Paul on that.
Yeah. Some people like the traditional IRA contribution simply because they need the tax deduction. And that works for some people who, when they're retiring and they take the money out of their IRA, they're going to be in a much lower rate. So possibly they got a deduction at 30%, and when they take it out to be taxed, they're only going to get taxed at 12 or 15%. That's some good analysis. But again, it's facts and circumstances and specific to the individual client.
That's a great explanation from a CPA. A normal person really doesn't comprehend that the first time we hear it. But it has
I
to
just
do
made it up, so I'm happy it worked out.
it has to do with the rate going in and the rate coming out,
Absolutely.
because everything changes
Yes.
when you're into your retirement years.
Mm-hmm.
This is good. What about savings accounts? Regular savings accounts, money market accounts. You're still going to be paying taxes on whatever interest that you get on that.
You are, but the good news is the rates have gone up, and probably will go up a couple more times this year. The new Fed governor comes in February, early February, and we're expecting him probably to raise rates 2 times if the economy keeps going at the pace it's going. So that would be
You're
good
saying
for
two?
savers. Two more rate increases, yes. So probably bring it up to 1.75 or something. But that's good news for savers. We're starting to see some money being made in savings accounts.
Oh, so there's actually going to be a reason to put money in the savings account in the bank these days,
Yeah.
in the future at some point.
Other than fear of a cataclysmic event, yes.
Well, I think it's safe, though.
It's safe, yeah. It's FDIC insured. You know, and quite frankly, for the last eight or 9 years, a lot of people have missed this market because they were so concerned about what happened in 08 that they're still sitting in those savings accounts, unfortunately. And that's where we think that euphoric third leg, which is what Morgan Stanley's talking about, we actually think we're not quite there yet. We think bull markets generally last about 14 years. We think we're really about 4 or 5 years in. We might have 9 more years of this kind of market.
So you're talking Dow 30,000.
Yep. Not right away, but,
Not right away.
but down the road. And there's going to be a correction, Barry. You know that. It's coming. So I would say to everybody, be prepared. It's probably going to happen, but it's going to be short, sweet, and then it's going to go right back up again.
Well, over the years, and I'm old enough to remember, and I guess you guys are too, you know, it was 87, there was a terrible day. And then we had 9/11, and then we had 08. But the market has rebounded from all those terrible days. In some cases, from 2011, I think it took a couple of years until we came back. But people who are older, approaching retirement, your horizon is shorter.
Horizon shorter. Can I give you an example of 1987? I
Please
was
do.
actually around then. The day it happened, I had someone call me and say, sell my mutual fund, which we did, and we were able to take that money and put it into a 10.5% 30-year U.S. Treasury bond. Now, that was unbelievable. So that was an easy transfer. You know, the market was doing well. We went right into a 10.5% bond. If you were to do that today, a 10-year yield is about 2.3%. So it's just not the same. There's a whole different world out there than there was in 87.
Well, you look like the smart guy that time, huh? You know, there was blood in the streets, and somehow you made
It was an easy one.
you made lemonade out of
an
those
easy one.
lemons.
It was
Well,
an easy
interest rates were higher in the 80s for sure.
Oh, yeah.
I can remember when there were not mutual funds, but money market accounts. They were paying 15 and 16%, but I think mortgages were probably 18% in those days.
Yeah, that's
as
the
well.
end of the Carter.
The Jimmy
end of
Carter
Jimmy
years.
Carter, yeah.
We don't want those days back.
don't want
those
No,
days.
those are
Those are
high
tough days.
inflation, and those are very difficult to catch.
Why is inflation under control so well?
A lot of factors. You know, interest rates are very low around the world. Right today, Switzerland's 10-year Treasury bond is minus 0.187. So capital is coming here. It's making our dollar stronger. The Amazon effect is keeping prices low. The labor costs around the world are low. So there's just an incredible amount of perfect things that happen. That's why that Ed Sheeran song is so good. That happened this past year to keep inflation down. We're starting to see inklings of higher inflation due to wage pressures. That's something we're going to keep our eye on this year. That's a potential negative.
But if inflation starts to show its ugly head, they will raise interest rates, won't they?
They will raise interest rates.
To control it.
Yep.
All right, you stay right there for a moment. We got one more segment here. What changes will business owners see with the new tax law? We'll be talking about business when we return. You're watching 22 News in Focus. You're watching 22 News in Focus. Today we have been talking about how the new federal tax reform law will impact your taxes and personal finances. For people who own businesses, whether big or small, there are some new incentives. There is a corporate tax rate. The big corporate tax rate, as you mentioned before, Paul, has come down significantly.
Yeah, unbelievable, Bear. 35 to 21. Mark and I were talking in back. That is basically telling a big corporation, an Apple, if you will, that that's a 14% increase to your bottom line. That's a big
And
number.
Apple's almost $1 trillion company. They're like 900 million or something like that.
Yeah, they're paying their bills. So so these corporations are getting a big break. Yeah.
So what about, and I was wondering about that, about the big corporations paying much less. This was sold as and is entitled a jobs act. It's supposed to create jobs. Do you see that happening?
Well, that remains to be seen. I mean, you know, Mark follows corporations in investing a little better, but the idea is that with the money that's saved, you do something productive with it.
Right. Right. Well, I can see a couple scenarios here. If corporations do what they did back in the 80s, they get this big tax cut and they just buy back stock and increase dividends a little bit, nothing happens.
And that's what Elizabeth Warren is complaining about. She's saying that it's just an opportunity for them to make themselves richer, bring up their own stock price. Do you see that happening?
Well, I think it's a little different now, because when you talk to CEOs 5 years ago, we're not investing, we're not sure, there's too much uncertainty about Obamacare, about what's going on in the world, et cetera, et cetera. I think CEOs now feel a little bit better about investing back in America. We've got some energy plans, we've got lower interest rates, we've got the rule of law, we've got all kinds of things here that favor America. So I think this time it might be different. We'll see pretty early if corporations start announcing big plant and equipment and hiring of employees and bringing employees back from overseas. That will be a real positive for the tax cut. If not, Elizabeth Warren might end up being right. And I hope she's not, because I think this is a golden opportunity to do something really good for American middle class workers.
I'm really hoping so. So that's the big corporations. What about the mom and pop businesses? Is there anything in there for them?
Well, most mom and pop businesses, Barry, could be profitable. They tend to operate closer to break even, because there's tough times for small mom and pops when you're dealing with the Costco's and the bigger markets that are out there, et cetera. But I would say that most small companies are taxed as what we call S corporations, and they got a tax break too. Not quite as big as the big corporate tax break. It's not 35 to 21. It's more like down to 29%. But there is a break there, and that is what I was referring to earlier. The busiest part of my coming year, Barry, is for all CPAs, tax attorneys, is the analysis of, are you the right form of business, mom and pop, going forward?
Should you be an S corporation or
switch to a regular C corporation if you're profitable to take advantage of this rate reduction? There's going to be a lot of discussion on that.
As we've been saying, we're very early on in this process of the new law. Looking forward, what are you telling your clients with regard to any changes you might want to make this year so that you can file next year and put yourself in the most favorable position to do that?
Well, what I'm telling clients right now is that you have to make sure the asset allocation model is right. We've had a big run up in stocks, so now people are probably overexposed to the market. We need to cut that back a little bit. But going into bonds is a little bit tricky right now because it looks like rates might be going up. So it's a little dicey time to be doing asset allocation, but always the right word is diversify, diversify, diversify.
I've always had a problem with that, but we're not here to discuss my problems. But you were talking about interest rates creeping up.
Yep.
You also talked about oil prices being higher. You have had the contrarian sort of view that oil prices going higher can be good.
Yes.
How is that?
Well, more demand for oil worldwide means the world is actually growing faster than expected. That's just a clue that things are going well. There's also trouble in some hot spots, like Venezuela is having trouble. That might be collapsing, and they supply 1 to 2% of the oil in the world. So higher oil prices could be back to the old days where we worry about regional hot spots, or it could mean real positive future growth for the world. And the markets are telling us that it's real positive future growth for the world. So I take that as a good sign. We're over $60 a barrel now. The last 3 years we've averaged about 50. So we're up about $11 a barrel.
And some of us remember when it was 135, and that wasn't all that long ago.
Yeah.
So we don't want to go back to there, though.
No, but another area, Barry, is housing. There's a shortage of single-family homes nationwide. And problem is, a lot of the people that really need to buy a house can't qualify.
Right.
FICO scores. I noticed recently the FICO scores have been modified, so more people are eligible. I don't know if you know about that or comment about that, but that's an area that I think could really drive this economy this year.
I hadn't heard about this. Big surprise. So you're telling me that banks are sort of loosening the purse strings a little bit?
Yes. So that more people will qualify to buy a mortgage, yes, because it's desperately needed. People do need to build these homes to so they can move out of their parents' basement and get into their own home, get their careers going. The millennials have really been on a delay program for a while. Now it's time to get going.
Yeah, speaking of housing, I know someone who's in real estate, and he was saying that some people are worried that because of the SALT, the state and local tax caps and certain other restrictions and mortgage rate interest, that it might be a disincentive for home ownership. And some people are thinking about pulling their properties off the market and wait and see what happens, see how this shakes out. So there's two ways that could split. Yeah. I mean, usually you say if there's less inventory, that would drive prices up. But if there's less inventory because there's less interest, then that's not the case. How do you view this?
The only thing I would say to that, Barry, is looking at home ownership tax neutral. Rent, you're not getting any equity. Home ownership, you're getting equity. Your mortgage payment is a savings account with respect to the principal amount. So tax neutral.
This is very good to point out.
I like buying over renting. Yeah. But again, standard deduction did equalize the playing field and make it more attractive for renters. But my advice, and I'm sure Mark would echo, as a savvy investor and advisor, quite simply, when you weigh the two together, home ownership seems to be better.
Right. And the American dream, it's a subconscious thing. The American dream is to own a home, not to rent a home.
It's always out there. It's always out there. I'm wondering what is next for you guys. You know, what are you guys going to do now? I mean, do you see that your jobs are changing as a CPA, as an investment advisor?
You know, there's always a bull market for investment advisors. This world is so complicated to try and figure out. I know there's lots of ways to do it yourself, but there's just so many things out there. Like we worry this year about inflation, the U.S. dollar, Donald Trump's tweets. You know, we worry about, you know, all kinds of things going on in Russia, North Korea. So there's always a worry out there. So we're, you know, even though the market's at all-time highs, this is the most unloved bull market in history.
And that's interesting when you talk about North Korea, because we've had a few scary moments this year, and it didn't really ding the market.
Shake it off. Taylor Swift. Didn't worry about it.
Taylor Swift. What about this? There's this weird investment. I don't know if you couldn't call it an investment. It's just something weird out there, this Bitcoin thing. What's up with that? It seems to have taken on a life of its own. Some people are speculating. Some people are winning. I got to think that it's a frightening thing to get involved in at this point.
Well, they're calling it the digital gold for millennials. You know, under the heading of money wants to be free, it wants to be frictionless, which means not taxable, and it doesn't want to be tracked. Bitcoin is the perfect foil for that. So, you know, you've got all these digital cryptocurrencies emerging because there's some really interesting technology behind it that corporate America loves. So they're really interesting. And now the value of all the cryptocurrencies is somewhere around $600 billion. That makes it something to be reckoned with. So this year we'll have to deal with that. Either they regulate it to death, or it becomes free and it becomes a second asset class, a new asset class that we are all going to be talking about in trading.
Paul, are you frightened by it?
Well, for me, technology peaked with frozen pizza. So besides that, but you know, it's not. I'm a little concerned because it's not backed with like the faith of the United States government behind the dollar.
It's not regulated.
That's my concern. But I have to defer to the experts in that field because again, frozen pizza, Barry.
Who are the
we
experts?
Can't even talk about it with clients. We can't talk and speculate on it. We can't buy
That's
it or sell
probably a
it.
good
So
thing.
I think that's a healthy thing because it's too early. We got to be careful.
All right. We'll have a last word for you right after this break. Stay with us. You're watching 22 News in Focus. Today we've been discussing the new tax legislation that became effective on January 1st. I'd like to thank our guests, Mark Teed and Paul Mancinoni, for helping to shed some light on what we're going to be looking forward to this year and from now on, of course. That is our program for today. We thank you for watching at home. If you missed any part of it, you can watch it in full on our website at wwlp.com. From all of us here at 22 News, we wish you a wonderful Sunday.